The game in our kind of life is being able to recognize a good idea when you rarely get it.
Warren Buffett and Charlie Munger are two of the most famous investors in the world. They are known for their unmatched success and investment wisdom. Even though there are a lot of resources on their strategies, a surprising number of investors still fail to follow the tried and true steps. Today, we are going to talk about the secret to building the perfect compounding portfolio, which is the same strategy that has helped Buffett and Munger do so well for decades. By the time the video ends, you will not only know the basics of their strategy, but you will also have a look at a potentially excellent portfolio that consists of the top 8 compounding stocks they hold. First, let's talk about Warren Buffett and Charlie Munger. They are the most powerful investors in the world. I bet you've heard their names a crazy amount of times. But even though their strategies are studied far and wide, it's surprising how few actually apply them. They're the kings of compounding stocks, choosing companies that don't just grow, but explode in value over time. Now let's get into some numbers that might just blow your mind. As an example, look at Apple. Since 2001, its stock has surged by over 15,000%, turning the tech giant into the main part of Berkshire Hathaway's portfolio. Then there is Coca-Cola, which Buffett has invested in regularly since 1988, and which has consistently paid dividends, making a big difference in Berkshire's overall returns. These examples show how important it is to choose companies that have the potential to grow and keep their value over time. Berkshire Hathaway, under Buffett's leadership, has outpaced the S&P 500 in a way that turns heads. We're talking about a level of growth that transforms a modest investment into a fortune over decades. But it's not magic. It's about being smart and playing the long game.
You really just had to have sort of the courage of your convictions. You had to have the willingness to do something when everybody else was petrified.
During the chaos of the 2008 financial crisis, while most were running for the hills, Buffett and Munger were calmly picking their battles and investing wisely. Buffett's advice is straightforward. Be fearful when others are greedy, and greedy when others are fearful. This strategy not only got them through the crisis, but it also helped them make money when the market got better. In today's dizzying economic climate, with global debt hitting a staggering $300 trillion, the wisdom of Buffett and Munger is more relevant than ever. They have always put their money on companies that are fundamentally strong and that will last. This is a very important strategy for dealing with the present uncertain financial times. One of his standout thoughts, our favorite holding period is forever, sums up their approach perfectly. It's not about quick wins, it's about building lasting value. If you want to be great investors like Warren Buffett and Charlie Munger, you need to make smart decisions, specifically your company's choice. It is not enough to just pick stocks at random. You need to find the best ones. The kind of companies that don't just lead the pack, but redefine the race entirely. Let's start with what it means to be the best in the industry. Once again, consider Apple. It's not just a company, but it's a cultural phenomenon, with over 1.65 billion active devices out there. Their grip on the smartphone market, especially in the US, where they consistently hold more than half the market share, is nothing short of dominant. It's like they've built their own empire. Now onto the concept of a pricing moat. Netflix is a stellar example here. Over the years, they've nudged their subscription prices up, yet their subscriber base just keeps growing. From $1.36 billion in revenue in 2010 to a whopping $25 billion in revenue by 2020. Netflix shows that if you offer value, your customers won't mind paying a bit more. Knowing what makes your product or service stand out is what makes it irreplaceable. Efficiency in operation is another key factor. Amazon went from making $34 billion in sales in 2010 to an amazing $386 billion in 2020, showing what can be done with good management. They've not just grown, they've scaled up smartly, diving into high-margin areas like cloud computing, which has significantly boosted their profit margins. And let's not forget the importance of a constant demand. Procter & Gamble's enduring presence in households around the world, with a 5% net sales increase in FY 2020, demonstrates the value of having products that people always need. It's about creating something that becomes a non-negotiable part of daily life. Debt sustainability is of the utmost importance too. Look at Microsoft. They've managed their finances so well that despite having the capacity to take on more debt, they've kept their debt-to-equity ratio impressively low. It's a balanced approach to growth, ensuring they're not over-leveraged, but still ready to make bold moves when necessary. Lastly, efficient asset flow is where Buffett's own Berkshire Hathaway shines as a prime example. The company's book value went from $19 per share in 1965 to $261,417 per share in 2020. This is a great example of how to invest money strategically and use capital wisely. So, when we talk about picking companies, it's not just about the numbers. It's about understanding the story behind those numbers. Companies that lead their industries, command pricing power, operate efficiently, enjoy constant demand, manage their debt wisely, and allocate assets efficiently are the ones that stand the test of time. And that, my friends, is the Buffett and Munger way of building a portfolio that's not just robust, but designed for growth. Now let's talk about attitude execution. Starting your investment journey with the right mindset is a challenge. This is why attitude execution is key, particularly if you aim to mimic the success of investment giants like Warren Buffett and Charlie Munger. Their success isn't just a byproduct of the choices they make. It's deeply rooted in their approach and mindset towards investing. First off, let's talk about consistency. It's easy to get thrown off by the daily highs and lows of the stock market. But Buffett and Munger, they stay the course. It's not about making reactive decisions based on the market's mood swings. It's about having a solid strategy and sticking to it. This kind of consistency is what turns good investors into great ones.
The lesson of following logic rather than emotion, is something that it's obvious, and some people have great trouble with it and others have less trouble.
Now, on to using logic over emotions. Investing can often feel like a high-stakes game of poker, where emotions run high. But here's where Buffett and Munger set themselves apart. They approach investing with a cool, calculated logic. They assess, analyze, and act based on rational thought, not gut reactions. This logical approach acts as a buffer against the market's volatility, ensuring that every decision is grounded in solid reasoning rather than short-term feelings. And then there's what I like to call tomorrow thinking. This is where patience meets vision. Buffett famously said, "The stock market is designed to transfer money from the active to the patient." This says everything you need to know about tomorrow thinking. It's understood that true compounding takes time. It's not about quick wins. This mindset is about looking beyond the immediate horizon and seeing the potential of what lies ahead. It's about recognizing that some investments need time to grow, mature, and truly pay off. This long-term outlook is what has enabled Buffett and Munger to capitalize on opportunities that others might overlook because they're too focused on the here and now. Adopting the right attitude execution is about marrying consistency, logic, and a forward-looking perspective. It's about being steadfast in your strategy, rational in your decision-making, and patient in your approach. This trifecta of traits is what underpins the legendary success of Buffett and Munger. It's not just about what you invest in, it's about how you approach those investments. Transitioning from the mindset to the mechanics of investing, we arrive at assets handling. Here's where it all comes together. This is where Warren Buffett and Charlie Munger's ideas become real actions and plans. Handling assets is a broad term that includes everything from how you set up your portfolio to how you choose when to buy and sell. It's important to have a clear plan for each asset, know what roles it plays in your portfolio, and make changes as needed to make sure everything stays in line with your long-term goals. One of the key components of assets handling is what I like to call asset structure. To do this, you need to put together a diversified but focused portfolio that balances risk and reward in a way that fits your risk tolerance and investment goals. This is something that Buffett and Munger are very good at. They focus on industries and companies that they know a lot about, while making sure that they do not put all those eggs into one basket. This planned organization of assets is what lets them handle changes in the market and take advantages of opportunities as they come up. Lastly, we have right value assessment. This is where the analytical side of investing really comes into play. It means keeping an eye on your assets and make sure that they still meet the goals you set for growth, value, and potential. This ongoing evaluation is very important for making smart choices about whether to keep an asset, sell it, or buy more of it. It's a moving process that needs you to be alert, patient, and have a good eye for details. To really follow in the footsteps of Warren Buffett and Charlie Munger, You need to do more than just understand their strategies. You need to see them in action. Let us get to the heart of their investment philosophy by taking a closer look at those top 8 compounding stocks. These stocks could be the foundation of your perfect portfolio. Starting with Apple Incorporated, it's like the golden child of the tech industry. Its ability to come up with new ideas and make products that people can't live without has not only kept it on top, but also kept assets and demand coming in. Apple isn't just a company, it's a revolution that keeps on giving, making it a prime example of a compounding stock. Then there is Bank of America Corp., which is the big name in the banking business. It is the kind of business that Munger and Buffett would nod enthusiastically at. With its solid financial health and efficient operations, it's a textbook case of what it means to be the best in the industry. Coca-Cola is another name that resonates with strength and global demand. Its ability to maintain a pricing moat in the fiercely competitive beverage industry is nothing short of remarkable. It's got brand strength and market leadership that Buffett himself values deeply. American Express Company takes the lead in the financial services arena. It's not just a card in your wallet. It is an important part of a well-rounded compounding portfolio thanks to its sustainable debt model and efficient operations. Even though Kraft Heinz Co. has had some problems, it is a great example of the long-term demand and efficient asset flow that Buffett supports. It shows that you have a good sense of value investing because you are betting on the fact that people will always need food and the other goods. Verizon Communications Incorporated dominates the telecommunications sector, showcasing what it means to hold a significant pricing moat in an essential, demand-driven industry. It's the kind of company that keeps the world connected, literally and figuratively. Moody's Corporation, with its unique position in the credit rating industry, not only has a pricing moat, but it also operates with efficiency that perfectly matches the criteria for a debt-sustainable and high-demand business. Lastly, BYD Company Limited represents Buffett's forward-thinking approach, diving into the electric vehicle and renewable energy markets. It's a play on the future, standing out for its industry leadership and the potential for organic growth. These 8 companies are more than just stocks. They represent a long-standing, strategic, thoughtful investment approach. Building your portfolio around such compounding stocks isn't just about following in the footsteps of the greats. It's about setting yourself up for long-term success in the ever-evolving market landscape. As we near the end of our journey through Warren Buffett and Charlie Munger's investment philosophies, it's become clear that their success is no accident. It is the result of deliberate decisions, a firm attitude, and strategic asset management. But the real question is, how will you apply these timeless principles to your own investment strategy? Which of these compounding stocks or strategies resonates the most with you? And how do you plan to integrate them into your portfolio? Share your thoughts and strategies in the comments below.